Hello, everyone. Welcome back to another episode of the Weekend Charts. I'm your host, Charlie Bilello, bringing you once again the most important charts and themes I'm seeing today in markets and investing. As a reminder, if you're watching this on YouTube, take a quick moment, hit that subscribe button to receive all the latest content from us. And we have a lot on the docket today, so stick around to the end. We're going to talk about the Fed having an inflation problem, a stronger U.S. consumer pushing up GDP, the growth rate in the U.S. Jerome Powell commenting on stock prices, something he doesn't often do, saying they're fairly highly valued. We'll dig into some of the valuation metrics that might support that. The new home discount in the U.S., some interesting data comparing new home sales to existing home sales. Gold glitters, silver shines, been an epic year for precious metals. Foreign investors were still buying American stocks. This is a reversal of what we were seeing a few months ago, and we'll end with something positive, as we always do, and that would be 150 years of human progress. So let's start out here with the Fed having a little bit of an inflation problem, and I'm saying that because they have their target level of inflation, that's 2%, and all the data points on inflation are moving away from their target. So the Fed's preferred measure of inflation is this core PCE reading. We got an update this week on this reading. This is ex food and energy. That moved up to 2.9%. That's the highest we've seen since February. Of course, well above their 2% target. And according to the Cleveland Fed, it's not expected to come down in the next reading, which is going to come for the month of September. And really between now and the next FOMC meeting, which we're going to get on October 29th, we only have the CPI report that's going to come out. And the expectation is it's going to show the hottest reading of the year, 3% for CPI. So the Fed has an inflation problem because inflation has been moving away from their target. And if we look at since January of 2020, it's been double their target. And so we're getting more and more of these readings above their 2% target. That's creating a bigger gap above this 2% trend line. And so the more the Fed talks about easing, despite this, the less credibility the Fed has in terms of fighting inflation, and more case they have to make that the economy is so weak and the jobs market is so weak that they have to cut interest rates despite the fact that inflation is running well above their target rate. So if we talk about the October meeting here, the odds came down a little bit this week with that inflation print and with the better than expected GDP number. We saw the odds move from above 90% for a rate cut at the October meeting down to 88%. So market's still very much saying the Fed's going to cut interest rates at the next meeting, bringing the Fed funds rate down to 3.75 to 4%. But if we go out to the December meeting, a little bit more of a chance that they might not cut, still above 60% here, 65%, but that's down considerably from last week when it was well over 70%. So there's going to be some debate, I would imagine, at the next Fed meeting about should we continue to cut rates at every meeting despite the fact that CPI is moving away from our target. And I would argue this is all CPI data that isn't really reflecting yet the impact of the tariffs, and that still remains outstanding because companies are just starting to replenish those inventories that they've been working off over the last few months. So we still haven't seen the impact, the true impact in terms of price increases from tariffs. That's going to take many more months to work out. And that could potentially be an additional factor driving CPI up in the short run. And it doesn't appear to be priced in terms of the Fed taking that into account and perhaps slowing down in terms of their rate cuts. Now, if we talk about 2026, what's interesting is the market is essentially taken away one of the interest rate cuts for next year and bringing that Fed funds rate back above 3%. So last week it was below 3% in terms of where market participants were expecting the Fed funds rate to end 2026. Now it's above 3%. So still expecting the Fed to ease next year in 2026, just not as much. And this idea that the Fed is going to go to a 1% Fed funds rate, which the Trump administration's been calling for, much lower interest rates, the market doesn't seem to be pricing that in at this point. And despite the fact that, according to Polymarket, Christopher Waller seems to be the leading candidate. He's on the Fed right now. He actually was one of the dissenting votes there, and he was the one saying they should have cut 50 basis points in the last meeting. Well, the market is essentially saying either he's not going to have enough influence or there won't be enough members to bring that real easy money policy into play for 2026. So if we look at his comments, I think that would be kind of consistent with that because he hasn't been talking about cutting interest rates down to 1%. He's talking about perhaps bringing them down to 3%, which they consider to be the neutral rate for that funds rate, Fed funds rate. So it'll be interesting to see in 2026 if we're going to have, even if he is nominated here, perhaps more fights within the Fed and the government saying monetary policy should be easy. Well, all that I think is going to be highly dependent on the direction, obviously, of inflation and employment over the next year. But I don't think it's a done deal that the Fed automatically is going to be super easy just because we have a new chair in place next year. So that'll be something to obviously to watch. And the market right now is not betting on a super easy. They're just saying the Fed's going to bring the Fed funds rate down to where they consider a neutral rate to be. So let's talk about this GDP report that changed those Fed odds, really eliminating one of the cuts and putting some doubt in terms of the cut at the December meeting. We got a stronger than expected GDP report on the Q2 update, and it was really driven by strength in the U.S. consumer, which is surprising a lot of people because consumer sentiment remains among its lowest levels in history. Very rare for the consumer to be this gloomy, with the economy seeming to be still doing pretty good, with the unemployment rate rising but still very low at 4.3%, and with the stock market at record high. Very rare to see it. Usually you see this type of reading when there's a bear market, when there's a recession. We saw it in the financial crisis. We saw it back in the early 1980s. But this type of reading, given everything else that's going on, doesn't seem to make sense. And what we've been saying is really watch what the consumer is doing, not what they're saying, because the consumer is very, very uncertain and very fearful in terms of what's going to happen in terms of inflation. You can see that in this chart right here, showing you the uncertainty of inflation. It's measured by the University of Michigan, so the same one that is measuring this sentiment index. And you can see it hit a record high, this inflation uncertainty, after the tariff announcements a few months ago. But it's steadily coming down since then, but still very elevated. So a big portion of why the consumer remains very negative is they're expecting inflation to come. They're really not sure. They expect the volatility around this expectation to be very high. So it's really fears about inflation driving a lot of it. And of course, if those fears are materialized, then we could see an impact in terms of spending. But right now, it's just fears, and consumers are not yet acting upon those fears. And we could see that in this retail sales data here, up 4.8% over the past year. That's a little bit above the historical average of around 4.5%. And even if we adjust it for inflation here, still pretty strong at 1.8%. So what was the revision in terms of GDP? Well, they moved second quarter GDP up to 3.8%. And so really reversing a lot of the damage there from the first quarter. And a lot of this is really strength from the U.S. consumer. So we can see consumer spending from services contributing 1.2% and goods 0.5%. So pretty meaningful contribution there. And the rest of it is really just an inverse of the first quarter. Net exports being a big positive. It was a big negative in the first quarter because we had that massive front running of the tariffs, where companies in the U.S. were doing massive amounts of imports into the U.S. That drove the net exports number to be a huge negative contributor in Q1. Then we saw the reverse in Q2, where companies are working off of those inventories. You can see here the detraction there. So all of this data in the next few quarters is going to be worked out. We'll get a better picture in terms of the economy, but at least for Q3, what the Atlanta Fed is projecting here is another strong quarter here, 3.9%. This is their highest estimate so far. And what's driving that is data that came out in terms of the PCE report there with the US consumer they're expecting is going to contribute 2.3% to GDP for the third quarter. So if that comes in as the Atlanta Fed is expecting, it's showing the US consumer is still in very good shape. The question is, what's the breakdown there? Is it even between income groups? Where are we seeing most of the strength in terms of consumer spending? And this has been a trend that's been going on the past few years, but it hit another record high here in terms of who is doing the spending. Well, the top 10% of income earners in the US are now spending about half of all consumer spending. That's a record high here. And in the early 1990s, it was about a third, so a meaningful increase. And if we look at the past few years, and you ask the question, well, why is this going on? There's a lot of factors going on here, but really the number one factor would be the huge inflation that we've seen over the past 5 years. Well, who is that disproportionately hit? Well, lower income earners for sure, and higher income earners are benefiting because they disproportionately hold more assets, and those asset prices, whether it's real estate or the stock market or other real assets, have appreciated at a far greater rate than the rate of inflation. So that's definitely driving more consumer spending from higher income groups. The question is that a problem here for the economy? Well, certainly it could be if we start to see those other income groups start to pull back more. Not a ton of evidence of that so far, but something definitely to watch here. This is not, I would say, a trend that you want to see continue higher here. You want to see people in all income groups contributing to spending. And that the big factor in the past few years has just simply been the massive increase in asset prices, and inflation is really most punishing to those on the lowest end of the income distribution. So the Fed's policy here, they're trying to boost the economy and saying they're worrying about the labor market. But of course, if that spurs higher inflation, who is that going to hurt? It's going to hurt the lowest income consumers. So keep that in mind in terms of there's always a trade-off between inflation and employment and the economy. And if you're really concerned about the lower income workers in the US, you have to really focus on that inflation component because it really hits them the most, because as a percentage of their income, they're spending a much higher percent on things like food and gas and basic necessities. Let's talk about Powell's comments on the stock market here. Doesn't often comment on them. Fairly highly valued. It's a little bit of a strange statement, not really committing to saying they're highly valued, saying fairly. What does that mean? He wasn't really pressed on this, but the fact that he said something at all, I would say, means something, because he usually kind of dismisses this type of question, saying they don't see any risk, that they look at financial conditions and they're not concerning. That's usually what he says when he's asked about this in terms of press conferences. But he did a speech in Rhode Island and he said fairly highly valued. Again, what does that mean? It could mean a number of things, but clearly the Fed is starting to at least observe what we've all been observing, the fact that stock prices have been outpacing underlying fundamentals. Any number of ways to look at that. Of course, we've been talking about all-time highs, hit another all-time high this week. That brings us to 28 for the year for the S&P 500, and that follows 57 in 2024, which was the fifth most of any year in history. And here's a different ways to look at valuation. I'm just going to go through a number of these here. The price to peak earnings ratio has moved up to 27.7. That's, of course, the highest we've seen since 2000. It's over now 60% above the historical median here of about 17. We have the price to sales ratio for the S&P 500, 3.3. That's more than double the historical median, 1.6. If we look at the Shiller CAPE ratio here, which smooths earnings over a 10-year period, that crossed above 40 this week. Only the second time in history that's happened, moving from below 40 to above it. The other time was in the dot-com bubble period in 1999. It crossed above 40. Didn't stop there. Moved all the way up to around 44 before the dot-com bubble peaked. And of course, valuations came down as prices came down. The S&P 500 had a 50% plus bear market. And of course, the NASDAQ was down over 80%. So in terms of valuations, hard to argue that they're fairly highly valued. I think by most objective measures, you would say they are very highly valued, at least talking about US large cap equities. And if we look at the Buffett indicator here, which not a lot of people talk about anymore, but this is what Buffett used to talk about. I don't think he's commented on it recently. It's looking at the value, the total value of the US stock market as a ratio to GDP. And back in 2000, this peaked at less than 150%, and we're at another record high. This is as of the end of June. It's only gone up since then of over 200%. In terms of market value to GDP. And just looking at the standard deviations on this chart, we're now above two standard deviations above the mean. Of course, we got there back in 2021. Then we had the bear market there, which took valuations back down, but now we're back above those levels again. So Powell saying fairly highly valued. I would say objectively, they're very highly valued in the US. And really the question is, do they deserve to be very highly valued based on earnings? So will future earnings meet these very high expectations? So market participants are pricing in a huge boom in terms of earnings growth because of the investments that companies, particularly the biggest companies, are making in terms of artificial intelligence. And if those actual future earnings don't meet these high expectations, then you have a valuation problem. But of course, there's a chance that they might. This is a revolutionary technology. We know that. And so the proof will be in the pudding. We're going to get earnings in a few weeks for the third quarter. If we continue to see strong numbers here, the market, of course, can, grow into this valuation with very strong earnings growth. And perhaps investors will, for a period of time, be satisfied with strong growth. And we don't know, in terms of this chart here, looking at the CAPE ratio, we don't know where the top of this is going to be. So just as we didn't know in the 1990s where this was going to peak, we don't know where it's going to peak today. And as I've been saying in the last few shows, given what AI is expected to do in terms of the economy and change every single business, it wouldn't be unreasonable to expect that people are going to get even more and more euphoric. So I wouldn't make any predictions in terms of where this valuation level is going to go. But just objectively speaking, with all due respect to Powell, I would say stocks are very highly valued objectively in the US, looking at US large caps. Different story if we're talking about international stocks or small caps or value stocks. But just looking at the S&P 500 as a whole, being objective, hard to say that they're anything but extremely valued at this point in time. Let's talk about the housing market here. The new home discount is an interesting thing that's going on. It's been going on for over a year now, but just some interesting updated data points here. If we look at the U.S. housing market index here, lowest level since December 22, and really behaving, if we look at the housing market in terms of activity, in terms of sales, all of that stuff, behaving as if it's in a recession. So the housing recession has been going on now for over 3 years, I would argue, looking at all of these different factors, very little transactions, very little sales. And we tend to see this in the past. We've tended to see this only during economic recessions. This is now a clearly different period of time. We're now 3+ years into it with no broader economic downturn, and we're seeing this very low level of activity. And why are we seeing it? Well, that's very clear. The reason why, it's that lack of affordability really driving it this time. So it's not job losses. It's not it's not unemployment. It's really that lack of affordability that's caused the housing market to be frozen. And if we look at this housing market index, it's a survey of U.S. home builders. And so why are they so negative? They're so negative because of this lack of affordability. It's hard for them to sell these homes at prevailing prices. And so what they've been doing in terms of new homes is cutting those prices, offering more incentives. In the last survey, 39% of builders reported cutting prices. That was the highest percentage in the post-COVID period, and the average price reduction was 5% in September. So what we actually saw, and this is just 1 month, and there's always revisions, so I don't want to make a lot out of this one reading, but we actually saw a spike of new single-family homes in the latest reading. It was the highest that we saw since January 2022, presumably because of these price reductions, making that home more affordable for the average person. Now, very different story in terms of existing homes. We're not seeing the big price reductions whatsoever. We're still seeing relatively low supply there, and so what we're seeing there is activity remains near record lows, about 4 million. The seasonally adjusted annually rate here about 4 million, which would be among the lowest years we've seen for the housing market in terms of sales in the past 20 years. And what's driving that in large part is simply this chart right here. The affordability remains near record lows. The percentage of your income that you would need to afford the median home for sale, 47%, way too high for most people. Doesn't make financial sense, not advisable to spend that much of a percentage of your income on buying a home, and that's why there's very few people in the market. Many people want to buy a home, but very few that would qualify to buy a home if they had to spend that much of their income on the home. So what we're seeing here as a result of all this stuff is a wacky situation where the median price of a new home is actually below the median price of an existing home. This is wacky, doesn't make sense, because of course you would think a new home should be costing more in terms of its value than the existing home, but because of the supply situation, because of this incentives offered by home builders, and because of the new homes being built in the past few years are gradually becoming smaller because builders are saying we need to build cheaper homes that are more affordable. All of these factors causing the median price of a new home to be below the median price of an existing home. You can see historically that's not been typically the case. And it's not the case because a new home doesn't need as more desirable, doesn't need as much upkeep and maintenance. So of course, all else equal, a new home should cost more than an existing home. And so this is just a weird moment in time where we're seeing this discount for new homes. And I'm not suggesting if you look at a given area in the country and you look at a new home and you look at an existing home and they have the exact same features, that new home is going to be lower in price. But I am suggesting that relatively speaking, so looking at the two side by side, well, the gap is likely much less than it's been historically, and that's just simply a function of supply and demand. More supply of new homes than existing homes on a relative basis to their history, and the existing home market still being driven in large part by that lack of affordability, the lockup effect, where people just simply aren't listing their homes because they can't afford to buy a new home based on prevailing interest rates. So still have the 30 mortgage rate above 6%. Even though the Fed cut interest rates, we're actually seeing the 30-year mortgage rate so far move higher, just like we saw last September. So not getting a meaningful move lower in terms of that mortgage rate doesn't help affordability, and you still have those elevated prices. Let's talk about gold and silver here. Gold glitters, silver shines. Money supply is increasing once again, hit another record high last month in the last 10 years, 83% increase, biggest driver, of course, of inflation. That huge inflation spike that we saw since 2020 is this enormous increase in the money supply. And people are expecting inflation to go up here. We talked about that consumer sentiment survey. This is a big driver of why sentiment remains so weak. People are expecting prices to go up much more than the Fed's 2% target over the next year. We'll see if they end up being correct or not, but that's the expectation. So why are people buying gold and silver? Part of it is this fear in terms of inflation, fear in terms of national debt, fear in terms of the money supply driving up. These are story-driven assets here. You can see gold now up 43% on the year, on pace for its best return since 1979. So you have to go back a long way, hitting record highs again this week. And silver now outpacing gold, which you tend to see during really the last stages of a huge advance in terms of the precious metals. We last saw this back in 2011, 2012 period when you saw a parabolic spike in both assets. So interesting to me to see now silver playing catch up here and now outpacing gold on the year, up close to 60% on the year. And if silver, we only have a few days left in the month, if it closes here at $46 per ounce, it would be the highest monthly close for silver in history, exceeding its peak back in 2011 and its prior peak, of course, back in the early 1980s. So something to watch there with a few days left in the month. And very interesting to see the strength in gold and silver this year, despite the fact that the financial equity markets and fixed income markets are doing so well. So it's not based on fear of a downturn at this point or things like that. We had that fear for a brief moment back in April during the tariff tantrum when we had a bear market and we had fears of recession, but the equity markets have recovered from that. We talked about the S&P 500 hitting all those all-time highs. You could see international stocks up 25%, having their best year in a long, long time. And what we're still seeing, though, is strength in the precious metals, gold leading all major asset classes, as we just said, silver outpacing that. So very interesting to see that 100% of assets in the green, and we're not seeing the strength in gold and silver due to perceived economic downturn. We're seeing it, I believe, based on this story of there's going to be inflation or fears of inflation and the uncertainty surround that being the biggest driver of the gains this year. Let's talk about foreign investors still buying American stocks. And this was a big concern a few months ago, was are foreign investors going to pull back in terms of their investment? We saw some of that back in April when the tariffs were announced. We saw the buying in terms of their holdings of U.S. stocks going down. Well, that has recovered and then some, hitting a record here, 20 trillion in terms of the latest data. And here's an interesting stat. Now, 30% of the U.S. total stock market value is held by foreign investors, which is a record with data going back to 1945. So kind of shifting the narrative here in terms of foreign investors are supposedly pulling back from their shares of U.S. stocks, but have since definitely recovered here, hitting record highs, both in terms of the dollar value and as a percentage of the U.S. stock market. So no pullback, despite the fact that international stocks are outperforming this year, maintaining that outperformance. And a lot of that, as we've talked about, is driven by the currency situation here, where U.S. equity investors have benefited from that rise in international currencies relative to the dollar. So if we look at the global equity markets this year, still have the U.S. in the bottom third in terms of performance, but of course, very different picture than we had back in April when the U.S. stock market was down in the year. Now it's up about 14%, but you can see the Eurozone, 32.5% standout performer. Emerging markets having their best year in a long time, up 26%. So international stocks, for the most part, outperforming U.S. stocks, but that isn't really deterring international investors here. They're still pouring money into U.S. stocks for now. Let's end, as we always do, with something positive. That would be 150 years of human progress. The best way, I think, to illustrate that, or at least one of the best ways, is to simply look at the real or inflation-adjusted value of the U.S. stock market over time. And we can see here $1 invested back in 1870, so a little bit over 150 years ago, is now worth over 33,000. So if you look at that compound growth rate, you're talking about close to 7% per year real inflation adjusted return for the stock market, despite the fact that we've had panics, we've had pandemics, we've had world wars, we've had many, many crashes in between. And Yet the stock market is 33,000 times higher adjusted for inflation. So the story of the stock market is really a story of human progress over time. That doesn't mean there aren't periods, and sometimes long periods, where it seems like that progress is moving backwards. We certainly have had that as well. But if you go out 20, 30 years, the US stock market has always been better than where it started. And that's because there's been human progress over that period of time. And on average, people are better off than they were 20 years ago, 50 years ago, 100 years ago. And you look at 150 years ago, there's really, of course, no comparison to today. All right, we'll end it right there. If you're watching this looking for a second look on your portfolio or your financial plan, reach out to us today at Creative Planning. We're in all 50 states, so we likely have a location right near you. Over 370 billion in assets under management and advisement, and we're here to help. So reach out to us today, creativeplanning.com/Charlie. I'll have a link in the show notes. Thanks everyone for joining me on the Weekend Charts. Have a great week ahead. If you're watching this on YouTube, hit that subscribe button. I'll see you next time on the Weekend Charts.